That's better.
Did it say we're recording?
I guess so.
Oh, there it is. Now share.
Mhm.
This is where we're at.
You want to share the screen, not the window. Or
Hmm.
all the way around.
You're right.
Does somebody else want to drive?
Yeah, I can do that. Okay. Well, I'll just change it to screen share. That way, if you click on any of the links in here, then the recording can still see it.
Hi, people.
He could just say next. Cool.
Looks like FM is a link. So anyway, for budgetary integration, we primarily use FM, which is funds management, to monitor budgetary spending, but due to how advances are handled and now how leases are handled, it's not a perfect gauge of where we are. There are some special reports you can run that you can figure out where you're at related to advances, but it's kind of clunky. And we prepare the act for using FI data, which is FILO or financial logistics or something. Both to eliminate the advance problem and now the leases problem, and to simplify the data needed in Gravity. There was initially when things went live, there were only 6.5 accounts in FI. So we had to pull 6.4 and 6.5 accounts from FM. But we came up with a whole new process where we could basically still everything that happens in FI related to interagencies records to 6.5 accounts. And there's a procedure that runs overnight and flips anything that has a credit, any record that has a credit in 6.5 to a 6.4. So it'll debit 6.5 and credit 6.4. So that happens overnight, every night. And then in FM, we do encumbrance accounting. So we encumber balances when a purchase order is issued, and that allows the bureaus to keep track of where they're at. But then on June 30th, we cancel all the purchase orders, and encumbrances are zeroed out. Now, a lot of governments do encumbrance accounting for budget, so that they don't zero out their purchase orders. And it has advantages, like in Montana, for school districts, it's advantageous to them to spend every dime of their budget authority. The way school budget law is set up in Montana.
Mm-hmm.
So basically what they'll do is that they'll get into June and the kids have gone home. And then they'll figure out, well, how much do we got? We paid all our teachers and everybody's been paid. So how much do we got left? And then they will go out and just start writing purchase orders for, like, replacing a roof, for resurfacing the basketball court, or whatever maintenance kind of projects they have outstanding. And then they'll use those purchase orders to create encumbrances that use up all of their budget authority. Now, when you go to the GAAP basis statements, you've got to get rid of the encumbrances because the work hasn't been done and the vendors haven't earned the money. It's just a purchase order that's sitting out there. But for your budgetary reporting, you go ahead and include the encumbrances, and then you reverse them back out for the GAAP basis statements. So if FM there is a link, yeah, check and see what. I don't remember what I did. Oh, there we go. This is how things are now. We've since I added CLM, so that's probably another layer in this, but we've got funds management, we got fund accounting, which is FI, we got CO, which is controlling and cost management, and then we got grants management. Now, for some things, they're called the same thing everywhere. So like a fund is a fund. But a cost center is a fund center if you go over to FM. And then where we call in a general ledger account in FM, it's called a commitment item. So there is some variability depending on which module you're in. Now, one weirdness is that CO does not recognize signs, which is why it always confused me. So like, if most of the budget is consumed in a particular area, so like if you got $1,000 of budget that's already left, and you go to credit an expenditure account for $2,000, it will block it saying you don't have budget authority, but you're reducing it. So why the heck are you getting that? That's because over in CO, it does not recognize positive and negative. It just goes and looks and says, you got $1,000 left and you're trying to do $2,000, so hard stop. And you have to then get a budget override in order to post the entry.
Oh, interesting.
Not to throw you off your train of thought, what's the difference in this internal cost management? The difference between primary cost elements and secondary cost elements? It's a third one in orange at the very bottom.
Okay. So that's just what they're called over, and so it's commitment item. In FM, it's called a GL account, and FI, and a primary cost element in CO, and a sponsored class over in. So 529000 is called something different as you move from one module to another module.
So then what's the secondary cost element? Like if there's a primary, what would
I'm
be
not
the?
sure.
Oh,
I
okay.
don't know.
No worries.
What's the relationship between like funded programs and internal order and all the cost factors?
Oh, yeah, because it's got the 3 going there and then the sponsored programs
I
also.
wouldn't have thought there was a relationship.
Yeah. And funded programs are an oddball thing that we initially really thought we wanted. But then we've kind of gotten away from them. And it mostly has to do with interagency stuff. And where it'll get thrown off. The original idea was that an internal order that starts with 7 is an interagency internal order. And what that does during settlements is it's going to create an expenditure in one fund and revenue in another. So basically the type of thing where Parks is doing work to help Vaught in one of their street constructions. They want to put a tree in or something. So they'll hire Parks to come in and do the Parks portion of the project. And they'll have one of those interagency agreements and use a 7 type internal order in order to record the expenditure and Vaught and the revenue in Parks.
How
Now,
does the entry balance?
Huh?
How does the entry balance then?
well, in Peabody, Fund 200,000, it'll debit the expenditure and credit cash.
Oh, it'll do it simultaneously?
Yeah.
Gotcha.
And then over in general fund where Parks is operating, they'll debit cash and credit interagency revenue. Now, one of the things that funded programs was that was the original concept. The problem is that this is probably a project over in Peabody. So they're actually going to be hitting a WBS element, not an internal order. So on one side, Parks is recording a 7 internal order, and Peabody is recording a WBS element.
Okay.
And then that throws the funded program out of balance.
Okay.
Which is why we kind of abandoned trying to balance funded programs. Initially, we spent a whole heck of a lot of time working on that, and we finally just kind of recognized that it's just systemic. And
No, so if I'm not mistaken, those are the codes at the bottom of the budgetary statements that lists all the transfers, right? Those funny codes.
no,
That's
those aren't cash transfers. Those are actual revenue and expenses. So that's an exchange transaction.
okay.
So where do we see the funded programs? Like at least with.
Well, it's like that internal order. That's 7 internal order. It is the
That
funded
is
program.
funded program, okay.
Sometimes there are entries that does not have internal orders, but cost centers only.
Hmm.
And the reason being
Kind of slice and dice the stuff for management reporting. So a cost center, the original concept behind a cost center and a fund center is that that's related to a manager. So for us, MFFS 00001 is accounting. So that's me. And everything under us is assigned to that cost center so that I can accumulate costs and understand what accounting is doing. Now, when we start to do things like work for debt and charge them, we have to create an internal order. Now, the type of internal order you use can vary a little bit. So since debt is an MF00 and we're in MF00 business area, we're in the same business area, we can't use a 7 internal order. So we use a 9 internal order. And then that just accumulates costs. They call it statistical order. It just accumulates costs and it doesn't do any kind of settlements when settlements are run. So it doesn't create that 6.4 and 6.5 automatically. But what happens is our budget person in the CAO's office periodically goes in and manually does that 6.4, 6.5 entry based on the costs that have accumulated in that statistical order.
So
Now,
the 9 IOs are in the statistical orders.
Yeah. And then where we work for FPD-NAR and help them do their financial statements, instead of DR00 and we're MF00, we don't have that issue. So we have a regular 7 internal order that just automatically does settlements at the end of the month and creates the interagency expenditures and revenue. So that's one of the purposes of internal orders. They can also be used to move stuff around to different cost centers or different funds. So like if they're the type of internal order, like if we wanted to have our cost settle over in the grants fund, we can set up an internal order. I think it's an 8 internal order, starts with an 8. It will shift that cost over to, and have it settled to the grants fund rather than the general fund. So normally your orders are used for a variety of purposes, but they're used to kind of slice and dice, step things down into finer detail than a cost center for management accounting purposes primarily.
Mhm.
And then a WBS element. Those are used to track project related costs. I want to say work breakdown system or something like that. Is what WBS stands for. It says capital projects, and they are generally related to capital projects. That you can have a capital WBS element and an expense WBS element. And that allows you to say, these are all costs related to this project. It's just that some of them are expenses and some are being capitalized. So, for instance, when we decided that we wanted to do an ERP system, we didn't know what ERP system we wanted, but we wanted to start tracking the cost of that project. Until you make a decision as to which ERP system you're going to buy, you can't capitalize it. But you want to keep track of how much money you spent on it. So you would use an expense WBS element, and then it would all be tied together with the project. And the project manager could look and say, okay, this was the first phase where we were doing the selection process. And here's where we made the decision and we started capitalizing the costs.
So in essence, I imagine that would kind of help keep tracking for like compliance, like budgetary compliance on the one hand, but then you also want to be able to segregate that which gets capitalized from that which should flush through your income statement.
Yeah.
Okay.
So, and then you can also have a revenue WBS element. So like if you're getting like help from another entity or something, or reimbursement or something,
Okay.
you can also have a revenue WBS element. Now there are rules for how each one of those go, but you can take I think online, we've got the capital asset and the project classes. You can take those and get more. And if you want to find out more, ask Summer. She knows more about this than pretty much anybody. So that's kind of how everything is structured. And it's kind of fascinating how it all fits together.
Yeah.
And next slide. Took us a long time for that one. Okay, chapter 2, fair value and investments. Historic cost is easily obtained from accounting records, and they're stable from period to period and provide a measure of cost. And historical cost is used in operations, for example, capital assets, depreciation of historical costs, or the useful life of a capital asset provides a measure of cost over time. And for assets that generate income, for instance, bonds, historical cost is useful, but not really where you want to be. Like Michael will use it to keep track of like which bonds we might want to sell. He might want to look at what our original cost was and what the gain or loss if he happened to sell it in order to free up cash to pay a bill. But for financial statement presentation purposes, we want to market to market. So we're going to take it to fair value. Now, at one point, everybody kind of thought, well, that's entrance value. But And I think it was 72. But yeah, it'd be 72. I think what they did is they changed it to exit value.
Oh, that's the next slide too.
Hmm?
That's the next slide.
Okay.
Okay. we can move this.
So entrance versus exit value. Fair value is the price that you would receive to sell an asset in an ordinary transaction between market participants at a measure. So exit price. And then valuation approaches. Level 1 is quoted prices from actual sales. So like stock market. Yeah. Lots of transactions happening, lots of buyers and lots of sellers. So it's a wide open market. And then quoted prices from actual sales of similar assets. And then unobservable inputs. So I think we got another link.
Would the second one be similar to like when you're buying a house and you're getting like a comparison? So like it might not be the exact same home, but it's a similar home in a similar area sort of thing?
Well, it's like when you do it, when you hire an appraiser to give you, so like I refinanced my house year and a half ago. I had to hire an appraiser, and the way they go about it is they start to look at similar houses in a similar neighborhood and what that sold recently, and based on that, they came up with a value. But I think that would be more like a level 3. Almost everything that we have is level 2. Because the bond market, although there is a market and things are selling on a day-to-day basis, it's not the same level of transactions as, say, the New York Stock Exchange.
Mhm.
And you're also dealing with somewhat dissimilar assets. So it could be that you're making an inference based on a $1 million bond at 3%, where we have a $1 million bond at 2.5% or something, as the marked interest. So you have to make some adjustments to get to the bond that we actually own. So there's a little bit of observable inputs that are factoring into the calculation, and we don't do this ourselves. It's done for us by the broker.
But how does it get into our system?
Michael Montgomery and the people in the Treasury office put them in based on what the broker tells us. And they do our mark-to-market entry now. We used to do it ourselves, but they're the experts on this, and so we outsourced it to Treasury. And we'll make that entry after round 1 settlements in AP 12. We kind of looked at it. There's 3 rounds of settlements in AP 12. And we kind of looked at it, and most of the cash changes happen after the first round, or in the first round. And cash really doesn't move around too much, and with round 2 and round 3 settlements. So anyway, we have them do it based on where we're at after round 1. And that way we get the entries put in before we close AP 12. So that on day 1 of AP 13, you guys can start working on your funds. You don't have to sit around and wait for that mark-to-market entry, because the mark-to-market entry hits every fund and changes every fund, so we want to have that particular entry done ahead of time. Same with compensated absences and pension stuff, anything that we can get done ahead of time. We don't want your funds changing any more than they absolutely have to.
Custodial fund entries.
So. And then the LGIP, and there's some time varying ones that are based on amortized cost. So like the LGIP, I think it's just like a dollar for dollar thing, and so there really isn't any difference, significant difference between fair value and what our account is worth.
Anything else here?
I don't think so.
Okay.
Capital assets. Now, this is one of the areas in governmental accounting, and I really think in all of accounting, where you really can't find a massive amount of information in the codification as to how you're supposed to do it, which is why GASB has a project underway to look at it. So GFOA has a capital asset book, and then there's some stuff here in the blue book, and you can find a little bit of stuff in the codification. But sometimes we go into textbooks and various places just to figure out what to do. So we are talking about something that's used in operations. So I think at one point we talked about property for resale, which isn't categorized as a capital asset. It's just put on the balance sheet, and then that we would mark to market. So there we would have to go to like an appraiser or something and try to figure out what it was worth and market to market for capital assets. I can see, I can make an argument for periodically marking them to market, but the tradition is capital assets are on a historical cost and amortized over some useful life. So has to be used in operations, has to have a useful life of over 1 year. So we got tangible, which infrastructure, buildings, land, vehicles, improvements, and equipment. And that would be what used to be called fixed assets. And then with GASB 34, the board decided they wanted to include intangible assets. So they changed the name from fixed asset to capital asset. And what's our, I think our next slide is probably intangibles. So software, right away, owning rights, leases. So it's some of our biggest numbers. Now, I talked about depreciation, but for infrastructure, GASB did in GASB 34, they did provide us with an option called the modified method. And basically what you do there is you say, okay, we're going to keep this infrastructure, like our sewer system, at a B level, and engineers will grade things in A or B or C or D. And we will maintain it at that level forever. So you don't, if you do work on the wastewater treatment plant, you don't capitalize it because you've already capitalized this and you're not depreciating it. And you're just doing what it takes to keep it at a B level. Now, I think there are some governments that have done that, but the number of who have chosen the modified method is really small. But and I think mainly because of that, you got to constantly be bringing the engineers into the equation to have them constantly reevaluating the system to say, is it still at a B level?
You probably have to consider inflation too at some point, right? Because like you can't expect that the cost to stay the same, even if the maintenance itself.
You don't factor in that. The only question is that wastewater treatment plant maintaining the same capacities as it did on day one? Are you still processing the same amount of effluent? Now, if you were gonna, like if DEQ or EPA came in and said, okay, well, you have to upgrade your filtration system in order to reduce the pollution that's getting dumped into the river, then you would be upgrading the plant to a new level and you would go ahead and capitalize that cost.
Yeah, that was gonna be my question.
But if you're just maintaining the same level of discharge requirements under your permit, and you're just continuing to basically do the same thing, you wouldn't capitalize anything more. But now the other thing that you get into with depreciation is how do you set the life? And I've kind of had problems with that. So for instance, for our streets, we're using a 50-year life.
Yeah.
Are we really gonna get rid of the street after 50 years?
And it's still carried at cost rather than replacement value.
Yeah. Now, there are rules as to, like if you strip a street down, and I don't know whether it's like 2 inches or 5 inches or whatever, it becomes a replacement rather than a maintenance. But if you're just like chip sealing a street to maintain it, that's just maintenance and isn't a capital outlay.
Like an outright expense. It's like we are considering it as an outright expense rather than capitalizing the cost of
Yeah,
maintenance.
and you get into the issue here, right? If you're replacing elevators, and we use 50 years again for our buildings, that elevators and the HVAC system and the roof were all in the original cost and are being depreciated. So if you replace a roof, you don't capitalize that. It's just maintenance.
But it extends the life of the asset. Wouldn't it should be capitalized?
Well, if you were at the 50-year mark and you were going to re-roof to get it to 75, then you would capitalize it.
Yeah, that's what I thought.
But if you're just re-roofing it to get from 25 years to 50 years,
Yes.
that's just maintenance.
Expense, yeah.
So these are all the kind of weirdnesses that you get into with capital assets and deciding, is it maintenance or is it capital?
Capital.
And then we get into some weird ones where Say, water is replacing a water main under a street. So they have to rip the street up in order to replace the main. And then they have to put the street back in. So water is wanting to put that street in as part of their cost of their water system. And Vaught is wanting to put the street in as part of their street system. Does it go both places?
Yeah, or where does it
Yeah.
go?
Yeah. So it's capital assets area is complex and interesting, and
Right.
so anyway. So basic accounting reporting, economic resources. Measurement focus, the focus is on the cost to acquire, construction, and improve. Those amounts are capitalized and allocated over the useful life. So tangible assets we're depreciating, intangible we are amortizing. But some people just say amortization, regardless of which, but current financial resources we recognize as capital outlay, the total amount of expenditure in the year that it is paid for. Capitalization is optional if the infrastructure required before 1980. And that goes back to NCGA Statement 1, which basically said that you should start keeping track of your infrastructure costs. That it didn't require you to actually report them in your financial statements back then. So since there was no requirement under NCGA 1 to have captured the pre-1980 infrastructure costs, when GASB 34 came along, they didn't require us to do it. You know, pretty much everybody went ahead and did it. And so like we hired the city of Portland hired a company to come in and estimate what the cost was. And that was an interesting period. And like, and also, we also went through it when intangibles became a thing. I think that was GASB 51, where we had to figure out, okay, what would it cost to do this today? And then we would use price adjust it back to whatever the estimated date of purchase was. So we would use CPI to price adjust it back down. So that was kind of an interesting period where we had some really fancy spreadsheets to.
Yeah, sounds like dollar value LIFO.
Yeah. So I think that was kind of fun.
Yeah.
Another thing that's optional is art and historical treasures. And we don't capitalize that, and we've got a lot of it. And then immaterial items. Now for land buildings and permanent land use rights, and permanent owning rights, our policy is to capitalize everything. For infrastructure, land improvements, and internally generated software, we capitalize anything that's over 10,000. And then for everything else, it's over 5,000. And 5,000 is kind of a GFOA recommended level. But some governments have gone much higher. And it's kind of interesting if you look at the studies. How much do you really lose in terms of dollar amount if you go from a $5,000 to a $50,000 capitalization threshold, and you don't lose, you lose a whole lot of individual items, but the dollar amount doesn't change too much.
So this one is irrespective of the size of the budget at the organization, right? This one, this threshold is irrespective of the size of the budget of a certain organization. So
This is just what we chose, and like I said, 5,000 is something that GFOA came up with a long time ago. And governments all over the country, regardless of size of the government, are using 5,000.
Okay.
And like I said, they did some analysis and kind of looked at a few governments and what does your total capital assets go down by if you get rid of the stuff under $5,000? And it really doesn't go down by much, but you lose a whole bunch of little stuff that, you know, why go to the trouble of keeping track of it? Which is why I have a problem with that new thing that they just passed, where they came out and they said, okay, well, we're not capitalizing this computer because it's under $5,000. But now what they're saying is, well, if you got 1,000 of them and they're $1,000 a piece, that's over $5,000 and you gotta capitalize them in the system. So we're gonna have to figure that out. Next winter, that's one of our projects for next year.
So
Now, we have to at least do that exercise so that we can go to Los Adams and say, okay, if you look at our computers and our radios and our office chairs, if we were to capitalize it and put it on the books, we're talking about $10 million. That's not really material. Can we just not do it? And then basically Los Adams would have a comment in the management, like a past adjusting entry in the management letter, saying that we didn't do it and this was the impact, and they're okay with it and they're not going to modify their opinion. But at the moment, Michelle wants to put them on because any excuse to increase our
fee.
that position is she wants to do it. So, but Summer and I don't want to do it, so we will have further discussions.
Complicated.
For consistency purposes. We have done this before, so.
So anyway, it's an interesting conversation. I personally wish they had waited until they finished their capital asset project to do anything like this, but and they did it just as a change in I think like one word and a Q&A. So I mean, I think the original answer to the Q&A was in that particular situation, you may capitalize it. And I think the change like may to must or should. And as accounting literature, for some reason, should means must, but so anyway, that one word change created some work.
So who's gonna be doing that analysis? That analysis for capitalizing our computers, desks. all
You
that
guys.
stuff, our team. Cool.
We'll have to send out some kind of messaging soon to have people start collecting the information, and then we have to, for BTS, you have to turn in a special ticket. So at some point soon, we'll have to put in that ticket and ask them for basically be a list of all the computers and when did we buy it, how much was it?
That has to happen this fall.
And
Should it be only for the new addition rather than all of them?
well, I mean, like with computers, we could assign it like a 4-year life to them. So we would be wanting everything that was purchased in 23, 22, 21, 20. So we wouldn't want everything. I think he should be getting ready here soon. Supposedly, we got 10 new computers. They're sitting over BTS being prepared, so sometime soon we'll get to 10 new computers and replace some of these. So anyway, it's something we'll have to work on next winter. To at least come up with an estimate of what it would be if we booked it. But how do you clearly define it? I mean, there's computers, there's radios, chairs. I think there's big trash bins out in the parks. Yeah.
Yes, Ron, I'm just wondering what will happen because if in the previous years it was already expensed, and then we found out that it shouldn't be because we have to capitalize it, then
Yeah.
how shall
So
we
we're getting a prior period adjustment.
prior period adjustment?
Yeah.
Okay.
So,
What's the minimum threshold for that?
well, it's an accounting change, so really doesn't have a threshold.
For that? Like. Not for proper adjustment, I mean, for the minimum amount that they're capitalized all computers. Or whatever, like 5,000.
5,000.
Well, we're at 5,000 now. So-
Same, okay.
If we have any equipment, cars, vehicles, whatever, that cost under $5,000, but if we have a whole bunch of them, it comes up to more than $5,000.
That's wow. I just wonder how much we spend on pens.
That's what I was
Like,
thinking.
we might spend $5,000 on pens.
We might have $5 paper clips.
Well, it's got to have over a 1-year life too.
Oh,
Can you imagine how many paper clips you'd have $5,000 worth of paper clips? You'd be like Scrooge
My
McDuck.
desk for
You'd
more
just
than a
be
year.
swimming in paper clips.
Yep. So,
Okay.
But those are not subject to capitalization because they are supplies.
So what statement is that we'll be working on in winter, fall, winter?
or it's a Q&A that they.
That's
the
a Q&A,
Q&A you
so
said.
frequently asked questions.
Okay.
So it's the one that came out for 2022, I think.
Okay.
Omnibus.
So capital assets situations where depreciation isn't recognized, assets with infinite life like land, permanent easements, and historical treasures. So if we did book like our art collection, we wouldn't depreciate it. Infrastructure with a modified approach, which we talked about a little bit ago, and then constructions in progress. So the same asset can't be reported by more than one government. And you get into situations like that where we just acquired 82nd Street from the state. So you got a street that's running through the city of Portland. But who owns that street? Up until a week or two ago, it was owned by the state. Now it's owned by the city. So the rule where it's really, and you can't really clearly define who it is. You can look at ownership, but if ownership is unclear, then you kind of look at who is maintaining it. So up until a couple of weeks ago, the state was responsible for maintenance on 82nd Street. So that's part of why they gave us an $80 million to upgrade it, because it needed dramatic upgrading, and they had ARPA money to help us with it, so they gave us $80 million for the grant money along with the street, so that we could do a bunch of upgrading and improve because there are issues out there with pedestrian issues, and yeah, it's just a lot of accidents and a lot of people been run over, and so it definitely needed to work. So
We're at 3:59.
So I probably should shut it off, and we'll start with 81 next time.
Oh, we have 3 more slides.
That's a
left on
nice
capital
discussion.
assets.